March 2008. Thomas and Ellen Ramirez, both 64, met with their financial advisor in San Diego. Thomas was retiring from a career in pharmaceutical sales. Ellen had already retired from nursing. They had $820,000 in combined retirement savings. They needed a safe, tax-efficient income strategy. Municipal bonds are perfect for your situation, the advisor explained. Tax-free income at the federal level. If you buy California municipal bonds, you avoid state taxes too, safer than stocks, more income than CDs, and you're in a high tax bracket now, so the tax savings are substantial. The advisor showed them the numbers. California municipal bonds were yielding 4.8% tax-free in March 2008. A $820,000 portfolio would generate $39,360 annually in tax-free income, equivalent to $58,000 in taxable income for someone in their tax bracket. Combined with Social Security of $48,000 annually, they'd have $87,360 in total income. Their budget required $72,000 annually, a comfortable $15,360 cushion. And the principal is safe, the advisor emphasized. Municipal bonds are backed by state and local governments. They rarely default. You're lending money to California, San Diego County school districts. These aren't going anywhere. This is as close to risk-free as you can get outside of Treasury bonds. Thomas asked about interest rate risk. What if rates go up and bond prices fall? You're buying individual bonds, not bond funds, the advisor explained. Hold them to maturity and you get your full principal back regardless of what happens to bond prices in the meantime. As long as the issuer doesn't default, you're fine, and California municipalities don't default. Thomas and Ellen built a municipal bond ladder in April 2008. 40 different California municipal bonds with maturities ranging from 2010 to 2028. Total investment, $820,000. Average yield, 4.75% tax-free. Annual income, $38,950. For the first 5 years, everything worked perfectly. The interest payments arrived semi-annually like clockwork. The bonds held their value. Thomas and Ellen lived comfortably on $87,000 annual income while their $820,000 principal remained intact. Then in 2013, Detroit declared bankruptcy, the largest municipal bankruptcy in American history, and Thomas and Ellen discovered that municipalities don't default was not actually true. By 2015, they were watching the news about Puerto Rico's debt crisis. By 2017, Illinois was on the brink of insolvency. By 2020, the COVID pandemic pushed dozens of municipalities into financial distress. And by 2023, Thomas and Ellen's safe, municipal bond portfolio had lost $340,000 in value, 41% of their original investment. This is the story of how municipal bonds, considered the safest income investment for retired Americans for over a century, became a trap between 2010 and 2024. How 1.8 million retirees who'd built their retirement income around tax-free municipal bonds watched their principal evaporate when cities, counties, and states ran out of money. And how Thomas and Ellen's $820,000 became $480,000 while they were promised safety. Municipal bonds have a long history of safety. From 1970 to 2007, the municipal bond default rate was approximately 0.1% annually. Defaults were rare, most occurred in small, obscure issuers. Major cities, counties, and states almost never defaulted. This safety record made municipal bonds ideal for retirees. Tax-free income, low default risk, predictable payments. You could hold them to maturity and get your principal back. Financial advisors recommended municipal bonds to high-income retirees who wanted to minimize taxes while generating safe income. The standard allocation, 40% to 60% of a retirement portfolio in municipal bonds, with the rest in stocks or other investments. Thomas and Ellen's advisor was following conventional wisdom in 2008. A 100% municipal bond portfolio was aggressive, but they were both risk-averse after watching the 2000-2002 stock market crash. They wanted safety above all else. The advisor selected high-quality bonds. California State General Obligation Bonds, rated AA. San Diego County Bonds, rated AA+. Los Angeles Unified School District bonds, rated A+. Various California city bonds, rated A to AA. None were rated below investment grade. All had strong credit ratings from Moody's and Standard & Poor's. All were backed by taxing authority, the power to raise taxes to pay bondholders. This looked bulletproof in 2008. California was the world's 8th largest economy. San Diego was a prosperous city. School districts had dedicated property tax revenues. What could go wrong? Everything. The first crack appeared in 2008-2009 during the financial crisis. California's tax revenues collapsed. The state budget deficit reached $42 billion. Governor Schwarzenegger declared a fiscal emergency. California didn't default, but its credit rating was downgraded from A to BBB, just above junk status. The downgrade caused California bond prices to fall. Thomas and Ellen's California state bonds, purchased at par $1,000 each, were now trading at $920 to $940. Should we sell? Thomas asked his advisor in early 2009. Absolutely not, the advisor said. Bond prices fluctuate, that's normal, you're holding to maturity. As long as California makes the interest payments, which they are, and pays back principal at maturity, which they will, you're fine. Selling now means locking in a loss. Thomas held. California did make its payments. The bond prices gradually recovered as the economy stabilized. By 2011, most of Thomas's California bonds were back near par value. Crisis averted, or so it seemed. Then came Detroit. In July 2013, Detroit filed for Chapter 9 bankruptcy. The city had $18 billion in debt it couldn't pay. The bankruptcy court eventually approved a restructuring that paid general obligation bondholders approximately 74 cents on the dollar. Bondholders lost 26% of their principal. Thomas and Ellen didn't own Detroit bonds, but they owned bonds from other California cities with similar financial problems: Stockton, San Bernardino, Vallejo. Stockton declared bankruptcy in 2012. San Bernardino in 2012. Vallejo had declared bankruptcy in 2008 and emerged in 2011 after cutting services and renegotiating debt. Thomas owned $40,000 in Stockton bonds and $28,000 in San Bernardino bonds. These bonds were now trading at 55 to 65 cents on the dollar because the market believed bankruptcy would result in significant losses for bondholders. The advisor's response: hold to maturity. Bankruptcy doesn't always mean default on general obligation bonds. Stockton and San Bernardino are still making payments. Don't panic, sell. Thomas held and watched and worried. The bankruptcy proceedings for Stockton and San Bernardino lasted years. During that time, the bonds paid reduced interest, about 60% of the contractual rate, and the principal repayment at maturity was uncertain. In 2015, Stockton's bankruptcy plan was approved. General obligation bondholders received 100% of principal, but no interest payments for the bankruptcy period. Thomas got his $40,000 principal back when the bonds matured in 2016, but he'd lost approximately $6,000 in interest payments during the bankruptcy. San Bernardino's bankruptcy was messier. The city argued it should pay pension obligations before bondholder obligations. The case went to court. Eventually, in 2017, bondholders agreed to a restructuring that paid 100% of principal but only 80% of remaining interest. Thomas got his $28,000 principal back in 2019 when those bonds matured, but he'd lost approximately $3,400 in unpaid interest. Total losses from the California city bankruptcies: $9,400, not devastating but concerning. These were supposed to be safe, government-backed bonds. Then came Puerto Rico. Thomas didn't own Puerto Rico bonds directly, but in 2010 his advisor had recommended diversifying beyond California. You're over-concentrated in California, the advisor said. If California has problems, your entire portfolio is at risk. Let's spread out geographically. The advisor sold $120,000 of California bonds and bought bonds from various states and municipalities across the country, including $35,000 in Puerto Rico bonds. Puerto Rico bonds were popular with retirees because they were triple tax-free, exempt from federal, state, and local taxes regardless of where you lived. Most municipal bonds are only exempt from state taxes if you live in that state. Puerto Rico bonds were tax-free everywhere. And in 2010, Puerto Rico bonds were yielding 5.8% tax-free, higher than most other municipal bonds. The higher yield reflected higher risk, but the rating agencies still rated Puerto Rico bonds as investment grade, BBB. Thomas bought $35,000 in Puerto Rico bonds in 2010, yielding 5.8%. Annual interest income, $2,030 tax-free. For 5 years, the bonds performed as expected. Interest payments arrived, no problems. Then in 2015, Puerto Rico announced it couldn't pay its $72 billion in debt. The government was effectively bankrupt. Bond prices collapsed. Thomas's $35,000 in Puerto Rico bonds were now worth approximately $12,000. His advisor recommended holding. Selling now means a huge loss. Puerto Rico is negotiating with bondholders. You might recover more if you hold. Thomas held. The negotiations dragged on for years. Puerto Rico's oversight board, appointed by Congress, developed a restructuring plan. Different classes of bonds received different recovery rates. Thomas's bonds were general obligation bonds, supposedly the safest category. The final restructuring plan, approved in 2022, paid general obligation bondholders approximately 45 cents on the dollar. Thomas received $15,750 for bonds he'd paid $35,000 for, a loss of $19,250. Plus, he'd lost approximately $8,000 in interest payments during the 7-year restructuring period. Total Puerto Rico losses, $27,250. Combined with the California city losses, Thomas had now lost $36,650 from municipal bond defaults and restructurings, and his portfolio had shrunk from $820,000 to $783,350. But the damage was just beginning. The COVID-19 pandemic in 2020 devastated municipal finances. Tax revenues collapsed as businesses shut down and workers lost jobs. Cities, counties, and states faced massive budget shortfalls. States couldn't declare bankruptcy under federal law, but cities and counties could, and many were on the brink. Thomas and Ellen watched nervously as news reports detailed the fiscal crisis. New York City facing a $9 billion budget gap. Los Angeles projecting a $400 million shortfall. Chicago's pension crisis worsening. Illinois on the verge of insolvency. Thomas owned bonds from several of these issuers. The bond prices fell sharply in March 2020 as investors fled to safety. His $120,000 in Illinois bonds, purchased at par, were now trading at $78,000. His $85,000 in Chicago bonds were trading at $61,000. His $140,000 in various California city and county bonds were trading at $105,000. Should I sell before it gets worse? Thomas asked his advisor in April 2020. No, the advisor said firmly. This is panic selling. The federal government will bail out states and cities. They can't let major municipalities default. Hold tight, these prices will recover. Thomas held. The federal government did provide some relief through the CARES Act and American Rescue Plan, but not enough to solve the underlying fiscal problems. By 2021, a new problem emerged: inflation. As the economy recovered from COVID, inflation surged to levels not seen since the 1980s. The Federal Reserve responded by raising interest rates aggressively. When interest rates rise, existing bond prices fall. That's basic bond mathematics. If new bonds are issued at 5% yields, old bonds paying 4% become less valuable. Thomas's municipal bond portfolio, with an average yield of 4.75%, lost significant value as interest rates rose. By late 2022, his bonds were trading at an average of 75 to 80 cents on the dollar. His $820,000 portfolio was now worth approximately $615,000 to $655,000 in market value. A paper loss of $165,000 to $205,000. This is temporary, his advisor insisted. Bond prices fluctuate with interest rates, hold to maturity and you get your full principal back. You haven't lost anything unless you sell. This was technically true. If Thomas held every bond to maturity and every issuer paid back principal as promised, he'd recover the $820,000. But Thomas was 78 years old in 2022. Some of his bonds didn't mature until 2028 when he'd be 84. What if he needed money before then? What if he had a medical emergency? What if Ellen needed expensive care? Thomas hired a new advisor, a fee-only fiduciary who didn't earn commissions. The new advisor reviewed the portfolio and delivered bad news. "You need to make some hard decisions," the new advisor said. "Your bond portfolio has significant losses. Some of these bonds will likely default or be restructured at significant haircuts. You're holding declining assets in issuers with worsening credit." "Should I sell everything?" Thomas asked. "That means locking in $300,000 in losses," the advisor said. "But holding means potential additional losses, and you're 79 years old. Some of these bonds don't mature until you're 85 or older. Do you want to spend the next 6 years worrying about which municipalities will default?" Thomas thought about his health, about Ellen's early signs of memory issues, about their 2 children living across the country, about the fact that he was supposed to be enjoying retirement, not managing a crisis bond portfolio. "What would you recommend?" Thomas asked. "Sell the highest-risk bonds, anything below investment grade or from issuers in severe fiscal distress. Take the losses. Keep the highest-quality bonds, California state highly rated counties. Diversify the proceeds into a balanced portfolio of stocks, bonds, and some inflation-protected securities. Accept that you've lost $300,000 and focus on protecting what remains." Thomas followed this advice. In early 2024, he sold approximately $180,000 worth of distressed municipal bonds for $98,000, an $82,000 realized loss. He kept approximately $340,000 in higher-quality bonds that he'd hold to maturity. These bonds would pay back par value if the issuers didn't default. He invested the $98,000 from sales into a diversified portfolio: 40% stock index funds, 40% high-quality corporate bonds, 20% Treasury inflation-protected securities (TIPS). His new portfolio structure: $340,000 in held-to-maturity municipal bonds, $98,000 in diversified investments. Total $438,000. From $820,000 in 2008 to $438,000 in 2024. A $382,000 loss. A 47% decline over 16 years. The emotional toll was as devastating as the financial loss. Thomas had done what he thought was right. He'd sought professional advice. He'd invested in safe government bonds. He'd avoided the risky stock market. And he'd lost nearly half his money. Ellen's response was heartbreaking. "We were careful. We saved for 40 years. We didn't gamble. We bought safe bonds. How did we lose $380,000? Thomas had no good answer. The advisor's reassurances in 2008, municipalities don't default, safe as treasury bonds, hold to maturity and you're fine, had all proven false. The reality: municipal bonds were safe when municipalities were financially healthy. When cities, counties, and states ran into severe fiscal problems, bondholders got hurt, sometimes badly. The diversification across 40 different issuers hadn't protected them because the problems were systemic, not isolated. When the entire municipal finance system came under stress, being diversified across stressed municipalities didn't help. Thomas's biggest regret was not diversifying beyond municipal bonds. In 2008, the S&P 500 was around 1,400. In 2024, it was around 4,800. If he'd put even 30% of his portfolio in a stock index fund, that $246,000 would have grown to approximately $840,000. more than his entire current portfolio. But his advisor had steered him away from stocks. Too risky at your age, you need income, not growth, bonds are safer. The irony, the safe bonds lost 47% while the risky stocks gained 243%. Thomas understands that hindsight is easy. In 2008, after watching stocks crash in 2000-2002 and again in 2007-2008, bonds seemed like the prudent choice. No one knew that municipal finance would experience unprecedented stress over the next 15 years. But the outcome is the same regardless of whether the decisions were reasonable at the time. Thomas and Ellen are 80 years old with $438,000 instead of $820,000. Their retirement is diminished. Their legacy to their children is reduced. Their financial security is shakier. The municipal bond crisis affected approximately 1.8 million American retirees who had significant portions of their portfolios in municipal bonds. The average loss among this group, estimated at 28% to 35% from 2008 to 2024. Thomas's 47% loss was worse than average because he was 100% in municipal bonds and owned several of the hardest-hit issuers. But hundreds of thousands of retirees experienced similar devastation. The municipal bond mutual fund industry also suffered. Vanguard Intermediate Term Tax-Exempt Fund lost approximately 18% from peak to trough during the worst periods. Fidelity Tax-Free Bond Fund lost approximately 21%. Looking forward, Thomas faces difficult decisions. He's 80 years old. Ellen is 80. They have $438,000 and need it to last potentially 15-20 years. Their current income: Social Security, $54,000 annually. Municipal bond interest, $16,200 annually from the $340,000 still in bonds. Investment portfolio income, approximately $2,500 annually. Total, $72,700 annually. Their expenses, $82,000 annually. The shortfall, $9,300 annually. Thomas needs to withdraw approximately $9,300 annually from principal to cover the gap. At that rate, his $438,000 will be exhausted in approximately 47 years. He'd be 127 years old. But that calculation assumes no more bond defaults, no more medical emergencies, no inflation beyond current levels, and no need for assisted living or memory care for Ellen. The realistic scenario is darker. If Ellen needs memory care at $7,000 monthly in a few years, that's $84,000 annually. Combined with Thomas's own living expenses, they'd need approximately $166,000 annually. Their income covers only $72,700. The shortfall would be $93,300 annually. At that burn rate, their savings would be exhausted in less than 5 years. This is the retirement crisis that safe municipal bonds created for Thomas and Ellen, not the comfortable, secure retirement they'd planned. A precarious financial situation where one health crisis could deplete everything. The lessons from Thomas and Ellen's experience. First, safe is context-dependent. Municipal bonds were safe when municipal finances were healthy. They became dangerous when cities and states ran into fiscal crises. No investment is absolutely safe forever. Thomas and Ellen's current plan is to stay in their home as long as possible, minimize expenses, and hope their savings last. They've cut their budget to $78,000 annually. They've stopped traveling. They've stopped giving money to their children and grandchildren. They're living frugally on the income they have. Thomas's biggest fear is Ellen needing expensive care. His second biggest fear is his own health declining and leaving Ellen alone without enough money. "We did everything we were told to do," Ellen said recently. "We saved, we invested conservatively, we hired a professional advisor, we bought safe bonds, and we lost nearly half our money anyway. How is that possible?" Thomas has stopped trying to answer that question. It happened, they're living with it, that's all there is. If he could go back to 2008, he'd do it differently. He'd invest maybe 30% in municipal bonds for tax-free income, another 30% in stock index funds for growth, another 30% in diversified bonds, corporate, treasury, international, and 10% in cash for emergencies. That balanced approach would have weathered both the municipal bond crisis and the stock market volatility. When bonds did poorly, stocks offset the losses. When stocks crashed, bonds provided stability. But in 2008, his advisor convinced him that 100% municipal bonds was safe. And Thomas believed it, because municipal bonds had been safe for decades, because the advisor was confident, because the credit ratings were high. All of those reasons proved insufficient when municipalities started running out of money. The municipal bond market in 2024 is still recovering. Some stressed issuers have stabilized, others continue to struggle. The total outstanding municipal bond debt in the United States is approximately $4 trillion. Of that $4 trillion, an estimated $200 billion to $300 billion is at risk of default or restructuring over the next decade due to unfunded pension obligations, declining tax revenues from remote work and commercial real estate collapse, climate change increasing costs for coastal cities,